private mortgage insurance is, so I'm the lender, I'm loaning you the money, okay? As a general rule of thumb, from a security standpoint, if you don't give me at least 20% down on the home, you're considered a risk. You're considered a higher risk. And that's kind of set by the agencies, Fannie Mae, Freddie Mac, okay? And I'd ask you the question too. If you got a buddy that asks you for a $300,000 loan to buy a house, you're gonna want some form of a deposit, good faith deposit, right?
Yeah.
And where 20% kind of comes up is in the event that you default on that home, you're gonna have to pay a real estate agent approximately 6% to sell the house, plus capital gains, plus excise tax, plus any others. You're gonna have to estimate about 10% in charges just to liquidate that house.
Yeah.
Then you've got to account for any late fees and penalties and depreciation if there is any.
Yeah.
So that's where the 20% factor comes in. So that's one way to avoid private mortgage insurance. So if you were to put down 10%, for example, the bank, we're going to require you to pay an insurance policy to insure us that in the event of default, we've got an insurance policy that will cover the foreclosure process, if you will, without getting into detail. Ways of avoiding private mortgage insurance. So typically private mortgage insurance is reflected in a monthly premium, or you can pay a higher interest rate and have the lender pay private mortgage insurance. So there's ways around, and what I'm doing with clients right now, especially with clients putting 10% down, they're opting for a higher interest rate because they're seeing the tax benefits of a slightly higher interest rate. So instead of, for example, I'm not quoting interest rates, but for example, instead of a 3.625 30-year fixed, they're going with a 3.875, paying a little bit of points and not having any private mortgage insurance whatsoever.
That's a good example.
Yeah, that's a great example.
Okay.
So that's the way to get around it.